comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Ladies and gentlemen, welcome back to another thrilling episode of State Tax Talks with Joe Tantillo. Today we have the grand finale of our conversation on New York's rules for the taxation of partnerships and non-resident partners. Once again, I am graciously joined by my colleagues Tim Noonan and Andrew Wright. Thank you both again for being here. We're going to pick things up where we left it off last time with part 3 of this series. Is it the rule that we use three-factor apportionment to source other types of income? We talked about ordinary income and loss, but you get a K-1. Do you just apply the BAP across the board to any income reported on that K-1?
No, you generally would do that if you're an S corporation, but the sort of idea behind partnerships and partnership tax is that, if we're all partners in a partnership, and the partnership sells stock of Amazon, we're treated as if we each sold 1/3 of the stock. So in other words, it's treated as a sale by us, not really as a sale by the partnership, at least for sourcing purposes. So capital gains, you almost pretend the partnership doesn't exist. You just, if the gain from the sale of whatever you're selling was New York source, like you sold the building in New York, okay, fine, we're paying tax on that. And we each pay our 1/3 share. But if we sell shares of Amazon and that's not, something that would be New York source income to non-residents, all good. Even if our BAP is 100%, you allocate that based on as if you directly sold that asset. If there's interest income, you allocate that however you would allocate interest income as a non-resident. Again, you essentially, for these purposes, you treat it as if the partnership doesn't exist and that as if the non-resident earned that item of income themselves.
Is that true, Tim, even of partnerships who are in the business of investing? Or what if I'm a private equity firm, right? And I'm in the business of investing and I got some ordinary income, sure, but then I've got interest, dividends, investment income from business.
I don't know, Joe, is there a way to stop the podcast and then I can go do research and then go figure out the answer and come back and be like, oh, Tim just answers. I think that's different, Drew. I think in that situation, those capital gains are if you're in the business of that, then I think it's different. So that's a good point. But typically that's not the rule.
So let's talk about then the sourcing of gains if the partnership itself sells an asset. We kind of alluded to it before as you talked about, if they sell stock and you have 3 partners, it's each partner sold 1/3 of that stock. But what about if the partnership it's selling is own capital assets? You mentioned real property. That's source easy. Of the location, the geographic location of the real property. What about items that are maybe less easy to pinpoint, where they are, intangibles, for example?
Yeah, a lot of times we'll have, and we've been in a bunch of these battles recently about the allocation of gain from the sale of intangibles, something like goodwill, if a partnership sells all its assets, they'll sell their furniture and their fixtures and their inventory. But a lot of times the buyer is buying the know-how and the trademark and the goodwill and that kind of stuff. Well, that's an intangible. So going back to what I said before, the partners basically treat it as if they sold their share of the goodwill. They sold their share of the intangible. So we got to open up the law books and how are intangibles sourced? And what the law says, non-residents only allocate income from intangibles to New York if only to the extent the intangible is employed in a New York trade or business. Mm-hmm. So that's the lingo in the tax law. There's nothing out there that really talks about how that works. And that really wasn't much of a problem in my life for 20 years, but it's been coming up a lot more. Going back to what we said at the beginning, they're doing more of these flow-through audits. Now all of a sudden we're messing with this whole question of how goodwill is allocated. And here's where things get a little bit circular, because what the tax department has been saying in a lot of these cases is, well, okay, if you're a non-resident and you have gained from a partnership's sale of an intangible, again, that's only allocable to New York by a non-resident to the extent it's employed in the New York trade or business. They say, so just use the BAP of the partnership in allocating the goodwill. And it's like, okay, I guess that makes sense. But then actually when you think about it and you look at the rules, it's like, no. You're only supposed to source the intangible gain to New York to the extent it's employed in the New York trade or business, not based on what the New York trade or business's allocation is, right? So how much did I use this intangible in the New York trade or business? That's the question you got to ask. So we're, in a various pissing matches, for lack of a better term, in a lot of these cases because we're getting tripped up with that lingo in the tax law about how intangibles are supposed to be sourced by non-residents.
Well, it's coming up, right, Tim, in all the situations where we have partnerships selling its assets, right? And so, something you don't necessarily have to battle with in run-of-the-mill audits, right. But a lot of these audits they're doing are when company sells, right? Yep. Someone comes in, they acquire business that's operating as a partnership, and they acquire the assets, and now we have to really consider the sourcing question. And I think, with the level of kind of, private equity activity and number of companies that are existing as partnerships, there's just a lot of this floating around.
What about if the intangible assets that's sold is a partnership interest that the partnership owns?
Okay, so that's sort of segue maybe into a next topic, which is historically, if you're a non-resident, again, a lot of these things are applicable to non-residents, and instead of selling the assets, which is going to generate all these questions about where the property is and whatnot, you just sold your interest in the partnership. That's an intangible. This battle got waged 30 years ago, but that's an intangible that's not employed in the trade or business. It's just like an intangible in and of itself. So like, I'm a partner in the Hodgson Russ law firm. I own a partnership interest in a business that's doing business in New York, but I'm not actually employing my partnership interest that I own in the business. It's just a thing that I own that represents the business. So it's a little bit of an obscure distinction, but that's the distinction and makes total sense. So makes total sense to me. So if I sell my partnership interest, I sold an intangible. It's not employed in a trade or business, and if I'm a non-resident, sweet, awesome. So that was, I guess, maybe somewhat of a loophole. I guess it's a loophole, but like over the years, if a partner, bunch of partners were thinking about selling their partnership and, it was based in New York and they said, oh, we're going to sell all the assets. Well, probably going to have to pay a bunch of tax if you sell the assets because all the assets are in New York. And New York takes a position that goodwill is based on the BAP, so you're going to pay a lot of tax. Well, what if we just sell the partnership interest? If the buyer is willing to just buy the partnership interest and not all the assets, oh, okay, voila, you just fixed the problem. Now you don't pay any tax. The same thing sort of comes up in the corporate context. If you sell the assets of your corporation, there'll be sourcing implications. If you sell the stock, generally there wouldn't be. So in any case, to answer your first question, if you sell the partnership interest, voila, you've solved the problem. But then Drew's going to tell us why that.
Well,
so of course there can't possibly be any added complexity.
Yes. Anyway, podcast over. So yeah.
The end.
Well, and New York did close that loophole with one really clear respect, right? Which is partnerships that own real property, mm-hmm. right? So, the idea of selling my partnership interests, okay, great, that's an intangible, unlike selling assets. So there was the loophole closing kind of provision that said if 50% or more of the assets of the partnership are real property located in New York, now because it
was like a big scam. Like I own a building in New York City and be like, oh, I'm going to sell it. I live in Florida. I'm going to sell it to you. Oh crap, I got to pay all this New York tax. Well, what if I put it in an LLC and I sell you the LLC interest? Okay, no more tax. So that shut down that loophole.
But yeah, much more exciting for us is the kind of deemed asset sale stuff, right? So the other kind of loophole closer, if you wanted to call it a loophole, was I sell 100% of my interest in a partnership in a transaction that falls under 1060 of the Internal Revenue Code. Now New York law says we deem that to be an asset sale.
Yeah, the reason, so New York came out with that in like 2017, applicable starting in 2018. And it sounds a little obscure, like Drew just said. Oh, in a transaction subject to our Internal Revenue Code 1060. I didn't even know what that was until because I'm not a real lawyer. I'm just a state tax lawyer. I'm like, what's
You're
that?
a real lawyer, Tim.
Yeah,
not a real tax
Yes,
lawyer.
exactly.
We're just kind of litigators who specialize in state tax.
Yeah, glorified accountant or something. I don't know what I am, but I didn't know what that was. But what it is that if it's in a transaction that's subject to 1060, the purchaser actually gets to treat it as an asset purchase, and that's relevant because the purchaser then gets a step up in the basis of the assets. If they just bought the interest in the company, the assets come over with the low basis. So the purchaser always wants that step up in basis. That's why most purchasers want to buy assets. But this 1060 provision allowed them to buy the interest, but also have their cake and eat it too, get to step up in basis. So New York looked at that, and they did this for corporations, which you're going to get to in your S Corporation podcast, 15 years ago. But this was, they said, well, we actually can do this for partnerships too. If it's really an asset sale, then shoot, we should tax as an asset sale. It's not exactly that simple, but that's the sort of rationale behind it, that it's for federal tax purposes, the purchaser is treating it as an asset transaction. So we're going to try to tax it that way for New York purposes too. So now all of a sudden in that situation, there isn't a sale of a partnership interest. They're treating it as a sale of partnership assets.
So just to briefly recap, to bring all that together. So there's a rule in New York, it was instituted in 2018, that if you have a situation where you have a transaction, you're selling 100% of your partnership interests, and then that transaction is subject to Internal Revenue Code 1060A, it becomes a deemed asset sale. So that's the restated version of what we just discussed. Let's say you now have one of these 1060A triggering transactions and you are in a deemed asset sale. What does that mean for the sourcing of your gain from the sale? What are the official mechanics of the rule, I should say?
Rewind 15 minutes in this podcast. We just talked about it, right? You're just you're selling assets. So where are the assets located, and do it that way. At least that's the way it should work. We're in another set of debates with the tax department about how that percentage should work. The tax department says, "Oh, just use the BAP for everything." What do you mean for everything? For everything, just use the BAP. That's what they say. They don't say that in the law. That would be fortunate if they said it in the law. It's not in the law, but it's their policy or whatever that you just allocate it all based on the BAP. That's really not the right answer. And, we're going to have to sort that out in some cases with them, but that's where it stands right now.
Yeah, stay tuned. Maybe in, who knows how long there'll be an episode about the great result of all of those various cases. We don't have to deep dive into all our deep academic thoughts on this particular issue right now, but it's an interesting special set of rules that is impacting a lot of people, a lot more people than it has in the past. And, we've seen it come up a whole bunch.
Yeah, it's part of their flow through push. This is something they're seeing. And
it's a really unique rule to New York. I think we looked at it and no other states have this kind of rule when you sell partnership interest in this.
Yeah.
For the most part.
There's a sniff of it in California,
yeah.
A little bit of Massachusetts, but it's not
exactly the same. But
there's constitutional potential implications. Can you tax a non-resident on the sale of an intangible? Maybe not. There's a case in Ohio that had a similar tax like this a decade ago, and it's funky. So there's definite constitutional questions as to whether or not they can even have a tax like this. And I expect it's a new law, and it's 2018. They didn't really start enforcing it until we didn't really see audits on this until 2020, 21. So we're in kind of the middle of the action on it.
Well, and the point you raised about not a lot of states having this is actually quite important, right? Because New York's coming in and they're suggesting to a lot of non-residents that they're going to have to pay a lot of New York state tax on the basis of this rule. And then you have a whole host of other states where these partners might live that have different rules. And, these partners have paid tax to their home state on this income. And now the question is, are they going to get a credit for the tax they paid in New York on this? And I think for a lot of states, the answer might be no.
Yeah. Which then creates double taxation, which we hate. It's our number one enemy on this show, number one enemy of the American people. I think an important point to make for people out there listening, because sometimes we get, very into the weeds with the various risks associated with random New York tax provisions, but you can structure around these 1060 rules, but you have to be aware of them in order to structure around them. And what I've noticed, again, in my very brief tenure, is that when people go to sell their businesses, they're not necessarily taking into account state tax implications, which we're going to be doing a podcast in the coming weeks. And we're actually going to be bringing on one of our federal tax attorneys to talk about that as well. But that, I think, is a key takeaway. If you're listening right now and you are a partner in a partnership and you know you have an impending transaction, got to be aware of state tax implications on that sale.
Don't forget about us. Like we're here too.
Yes.
We're real lawyers too, Joe. Yeah, I mean, look, it's right. And I think a lot of times in these transactions, there might not be a ton of flexibility. But I think in the 1060 space, right, for that to apply,
Hold on. How much do people pay for this podcast?
This podcast is free of charge.
Okay, well, I'm going to cut off Drew where he was going to go there because he was going to say situations where you could structure around this. And Joe, I just feel like your listeners should pay for that.
I think the beauty of this podcast is we give away so much of the secret sauce for free. Not all of it. We give away 10 herbs and spices, but not all 11.
Let's keep a little for the home team here.
Is it 11? I don't remember. I haven't had KFC in a while. Oh, well, contact
suffice to say,
Andrew Wright or Joe Tantillo if you're thinking about structuring a sale of your partnership interest. But it is something to definitely keep in the back of your mind. You have to keep those state tax implications. You have to have awareness of them. I think that unless anybody has other specific thoughts on the 1060 issue, we'll move into our final topic for today's show, which is the UBT. Just circling back to something we had mentioned at the top of the hour, this separate entity level tax in New York City. So tell us about it.
Yeah, it was my idea to add it as we sit here and talk. I think we need another podcast for UBT, Joe.
I think we definitely do need a full deep dive. But, we really haven't talked about any of the city business taxes on the podcast at length.
Yeah.
And we certainly should.
But maybe because we're talking about partnerships, there's a tax on partnerships in New York City. It's a 4% tax. It's an entity level tax. So all the stuff we said about, partnerships don't pay the tax. They pay this tax. I mean, it's a surprise one because people are like, what? I'm a partnership. I don't pay tax. Well, the city will impose that tax. It's got a lot of the same sourcing issues that we talked about, but they only have a single factor. So they only have the sales factor. And it's a little bit more traditional. They don't have the nonsense of the gross income factor, although interestingly, it's called the gross income factor, but they do the rules a little bit differently. So, yeah, I think probably, for purposes of like this general overview on New York taxes on partnerships and their partners, like suffice to say, look out for this one. But yeah, I would deeper dive that in a upcoming podcast episode. Keep them wanting more, Joe.
We gotta. Oh, plus we need content to fill. We gotta give these people a new episode every month. Well, guys, I think then that brings us towards the end of our discussion for today. Any parting thoughts for our listeners on any of the items we've discussed today, or just general concluding thoughts about partnerships and why you love them?
I don't love them. No parting thoughts. Call me if you have questions because Tim won't let me give out the secret sauce.
Yeah, no secret sauce. Yeah, I don't have any other interesting comments either. But a lot of fun.
We just gave 60 minutes worth of interesting comments, so that's fine. Well, thank you to both of you for joining the show once again. I certainly appreciate it. Our listeners appreciate it. To those loyal subscribers out there, thank you so much for tuning in once again. If you like the show, give us a 5-star review on your favorite podcast platform. We appreciate it. It helps us expand the reach of this program. If you have questions, you can always contact myself or any of the attorneys at Hodgson Russ, whether they be SALT or otherwise. Until the next time, this is State Tax Talks. I am Joe Tantillo. We'll see you real soon. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.